Hello everybody, welcome back to my channel where we talk all things finance and investing. Today's video, I'm going to talk about a problem that I see all too often in my day-to-day job covering clients from around the world who are investing in the markets. And that problem is they're holding too much cash. I see it all the time. People at risk averse, they've got way too much money in cash. They don't even like it themselves, but they just don't know what to do. So what I see in my day-to-day job is my clients tend to hold around 15% of their portfolio in cash only. Now, when I say cash, I don't mean bonds or other fixed income products like money market funds or anything else. I mean sat there only in cash itself. There's a couple of risks with this that you need to be aware of because not everybody thinks about it. Number one, what is the protection on your account if the company that you're holding the money with actually went bust? That's right, it can happen. It's not that common, but it can happen. We've seen it with Silicon Valley Bank recently, back in 2023, I believe it was. What protection would you get? A lot of places like the UK have a financial services compensation scheme that will cover you up to £85,000. But what about if you're holding above that? Well, in theory, anything that you're holding above the £85,000 would be lost if the broker that you're holding your cash with actually went bust. This is a risk that not a lot of people think about, and it's a very important thing to do. Now, you want to check if you're in the UK in particular, but check this wherever you're at. How are your client funds segregated from the business, and if they are actually segregated at all? So what does this mean? Well, in the UK, most required by regulated entities, brokers, they are actually required for the most part to segregate your funds from their business. So in the likely event that their business got wound up due to some insolvency or other issue, your cash is actually held in a bank account that's separate from theirs, and it's ring-fenced or protected from the company actually being able to access that money and to use it for their own business. So the money is sat there separated and protected for you to have, and the administrators would come in and have access to those bank accounts and know that that money actually belongs to the clients of this particular broker. So you'll actually have a much higher level protection with segregated funds. So make sure your broker is following this, whatever country you're in. It's very important. And if they're not, then you need to know, would the government, or is there any scheme that would protect you if that broker actually went insolvent? Now, if there's no segregated funds, then you need to think about how you're going to get this money invested. Now, there's another risk to having money just sat in cash in a brokerage account, and that is you're barely getting any interest on it. Some brokers don't pay anything. Some pay you 1, 2, 3, maybe 4%, but that's really about it. So over the long term, inflation is just eating away at this, and you're actually losing money. A lot of people don't realize this, but cash is actually a terrible long-term investment. In fact, the only cash you should have in, say, a bank account, for example, would be the cash that you would have as an emergency fund in case you lost your job or just suddenly needed some money to get you out of a problem like that. After that, you should start getting invested into investment products. It doesn't mean it has to be all equities. You could still look at bonds or other fixed income products as well. Okay, so let's assume you've got your money invested in stocks, you've got some money invested in bonds, but you're really not sure. You want to have some money on hand in case the market sells off and have quick access to that and get invested in the stock market with that money. Another option is a money market fund. These are very popular and for good reason. So what is a money market fund? Well, a money market fund, it's not that different than a normal mutual fund where a fund manager takes a pool of money and has a mandate to invest that in a particular way. Now, a normal stock mutual fund means that that fund manager will go out and buy stocks and shares in companies that he thinks will outperform a benchmark. But when it comes to a money market fund, what they're doing is they're actually going invested in very short-dated fixed income-like products. Things like bonds, for example, certificates of deposits and things like that. Money market is generally refers to anything that's going to mature in 1 year or less. So they're very short term, but they can be a great place to park your money. Why? Because generally the interest rates on these are higher than you would get in a bank account, and the investor protection, segregated funds and things I mentioned earlier are stronger as well. The best thing is about a money market fund is if you need to access that cash, you can just sell out of the fund, and within a day or two, the cash will be back into your brokerage account and you can withdraw it as you like. So this can be a great place to park your money. The interest rate that you typically get on money market funds is much closer to the SONIA rate. SONIA just stands for the Sterling Overnight Interest Rate, and that's very similar to the Bank of England interest rate. So a money market fund will get you closer to getting the actual Bank of England rate. These are very low risk investments, and they tend to be very low cost as well. There are a couple of money market funds that are very popular in the UK. And while this is not an investment recommendations of any sort, you could go and have a look at the fact sheets and the key information documents for the following funds and think about whether they are right for you. The first one is the Royal London Short-Term Money Market Fund. Now this comes as an income fund or an accumulation fund, meaning they'll pay out the income as an interest payment, or they will reinvest that into the fund and the value of the fund will go up accordingly to that. It's currently yielding around 4.4%, and the fee for being invested in this is only around 0.1%, also known as 10 basis points. So it's actually pretty cost effective. It has over £6 billion invested in it already, so it's actually the biggest money market fund in the UK. It pays its income biannually, so every 6 months or so you would get a payment out of this fund to reflect the interest rate that you're receiving. And it focuses on high quality short-term debt. The other one is the Vanguard Sterling Short-Term Money Market Fund. And the yield of that one actually tracks the SONIA rate quite well. It's a little bit more expensive at 0.12%, 12 basis points as it's known as. But this one pays the income monthly. So if you're an income investor and you like have that income come into your account, as I do, then this one may be a better fit than the other one I mentioned, which pays biannually. Obviously, Vanguard is a massive name in the investment world as well, so it may give you additional peace of mind where you're investing your money. As always, read all of the documents that come with these funds and make sure that they're right for you. And this is not an investment recommendation as such, just some inspiration and things for you to think about. But if you're looking to invest in a money market fund, which is not a bad idea for the portion of element that you want to keep in actual cash, let's say, keep in mind that over the long term, if you invest in a money market fund, you're losing out some of the great returns of the equity market. Have a look at this chart, which talks about the growth of $1,000 in a money market fund versus the S&P 500, going back from 2000 up to 2024, so just about 25 years. The blue line is if you had invested in a money market fund. As you can see, that $1,000 is only worth around $1,500 or so. But look at the green line, which shows the S&P 500. And if you put $1,000 into that, it's worth almost $6,000 now. So the longer you're planning to invest, and you should be a long-term investor, the equity market makes much more sense. So only put money into a money market fund that you're thinking about doing short-term while you're waiting to get it invested in the stock market. Also, remember, money market funds can move with interest rates. So if interest rates come down, then the fund will come down as well. So they're not entirely risk-free in terms of the returns that they're going to give. So what's your strategy? What do you do with your cash or the funds that you don't have invested in the stock market? Let me know in the comments section below. If you like this video on money market funds and where to park your cash, then click on that like button. And if you haven't done so already, subscribe to my channel. It allows me to produce more content like this for you. Also, if you want to know what's in my portfolio and how I invest my money itself, I have a one fund portfolio. I'll put a link to that video right here. So if you just click on that, I'll see you over there. And as always, I wish you nothing but the best in your savings and investment journey.